Up until this point, the focus of study has been on how individuals make decisions in their roles as consumers, producers, and entrepreneurs under the condition of scarcity, and how their spontaneous actions and interactions influence price and quantity in particular product or resource markets. So let's turn our attention to the whole economy made up of millions of individuals involved in the production and consumption of goods, services, and resources across all markets. In this aggregate economy, individuals still live in a world of scarcity. There are still trade-offs that must be made. Before we investigate what happens in the country at the macroeconomic level, we need first to clarify the important difference between micro and macroeconomics. Consider the impact of offering free education in the market for higher education. Microeconomists use the laws of demand and supply to investigate what happens to the price and the number of college graduates when government subsidizes all students going to college through taxpayer dollars. Student loan subsidies increase the demand for college, pushing up the price of higher education and the number of people with college degrees. Simple. Demand increases, and increases in price and quantity in the markets for higher education follow. Note, nothing in this microanalysis says anything about what happens in the economy as a whole. That discussion is left for macroeconomists. The focus of a microeconomist is on what happens in the market for higher education and/or the labor market for new college graduates, not in the economy as a whole. Let us look at the United States economy as a whole. We'll ask a big question. What happens if government mandates that free health care must be provided to all citizens? Government spending must be financed either through current taxpayers or by borrowing against the income of future taxpayers and households and businesses. So, the funding of government-sponsored programs and policies matters. When government spending increases, private spending decreases as taxes flow from households and businesses to fund the government-sponsored program. In this example, demand across the private sector drops when government spending on universal health care increases by taxpayer dollars. At best, there's no net effect. If inefficiencies emerge as health care shifts to government, there will be a net loss in production and employment in the economy. Conversely, if efficiencies are realized, there will be net gains. Now let's consider what is meant by price changes in the macro world. Price change in the aggregate market refers to changes in general prices. The media often reports aggregate changes in the Consumer Price Index, or CPI, released by the Bureau of Economic Analysis. Macro data analysts use changes in the CPI to say something about inflation in the United States, the rate of increase in overall prices. Price levels across markets change, impacting households and producers. When inflation occurs, prices increase across all markets over time. By contrast, deflation implies prices, on average, drop. From this point forward, our focus is the macroeconomy. When hearing about production, think about total production of all final goods and services in the U.S. When prices are mentioned, think of price levels across all consumers and/or producers. When analyzing changes in economic variables, consider how they impact the actions and interactions of consumers and producers functioning in highly complex aggregated markets. In other words, pay attention to a country's total production, consumption, and general prices.